I'm Jim Cunningham. Welcome to the Family Home and Family Farm Preserving Prop 13 Tax Base for Loved Ones today. We've got a lot of material to cover. This is a very popular topic with clients, and so let's get started. So this is a disclaimer. I'm a lawyer. I'm talking. This is not legal advice. So don't look at this and go out and say, hey, I saw this on YouTube, or I went to this webinar and I'm doing stuff. Bad idea. You need to reach out to an expert lawyer to help you with this. Go ahead and subscribe to our YouTube channel if you're watching this live. This is a great thing to do. It pops up in your feed. And if you're watching this on YouTube, please subscribe to our channel. I'm a lawyer. I've been practicing law for 25 years in the trust and estate area, which is exactly what we're talking about here. And we have offices in the Capital Region, San Francisco Bay, and Southern California. I'm a certified specialist in estate planning, trust, and probate law. It's very important. There are about 1,000 certified specialists in estate planning, trust, and probate law in California, and I think there are about 300,000 lawyers. So it's there aren't many of us. And I'm also a real estate broker and securities and insurance licensed. So Prop 19 has changed everything for homeowners and for family farms. So this is kind of the family farms is kind of a new topic. I think it's very important. And we're going to talk about what exactly is a family farm, because you may be surprised at what a family farm is and what a family farm is not. So let's get right to it. What we're talking about here, folks, is saving your low Prop 13 taxes. And saving your low Prop 13 tax base is worth protecting when it comes to your family home and the family farm. It is a very important, very powerful property right in California. But before we start, something that you do need to know. It is May 6th of 2021. Today, in the Government and Finance Committee at the Capitol in the California Senate, they're having a hearing on extending the deadline for Prop 19. This is Senate Bill 668. It passed 32-4 in the California Senate and has now gone to committee. It's gone through one rewrite. I've been following tracking this legislation. This is very powerful. So if you guys are concerned about preserving your Prop 13 taxes, you need to pay attention to this. One thing you can do is go on the California State Legislature's website, and you can track the progress of Senate Bill 668. We, in our law firm, we are internally preparing for Prop 19 to be extended. We're going to talk about some other issues that are going on with that, primarily having to do with the Biden administration's proposal to increase taxes, death taxes, and also income taxes. It's very important to understand Senate Bill 668, the mechanism. So if you're a lawyer watching this, and we have a lot of lawyers on here, if you're wondering how on earth can the legislature extend Prop 19? It was an amendment to the state constitution. How do they do that? Well, what they're doing, and if anyone is watching this who's involved with the bill, by the way, whoever wrote this is a brilliant lawyer, okay? Because at the Capitol, there are a lot of lawyers, but there's some attorney at the California Senate, I'm assuming, who came up with this brilliant idea to alter the definition of a change in ownership. And it effectively pushes out the date of implementation of Prop 19 to February 15 of 2023. That's the last day that you can, if this is extended, February 15 is the last date that you can make a parent-to-child transfer and avoid reassessment using Prop 58. If you don't understand what I just said, we have a lot of videos on Prop 58, which is the parent-to-child reassessment exclusion. But even if Prop 19 is extended, most professionals, what I'm talking about are CPAs, lawyers, financial advisors, insurance professionals. When we talk, everyone is assuming that our current $11.7 million gift and death tax exemption, which means the amount of money that you can give to somebody without paying a tax, you still have to file a Form 709 if you give over $15,000. But if you can give people $11.7 million, assuming no prior gifts, and that passes tax-free. So there's no gift tax when that property is transferred. We're expecting that to drop with the Biden plan to $1 million effective January 1, 2022. Now, they're also talking about dropping the death tax exemption to 2.5 or 3.5 or 5 million or whatever it is. But something very important to understand, for Prop 19 purposes, for Prop 13 preservation purposes, $1 million gift tax exemption is not helpful. It is very hurtful. And so what's going to happen is, even if you don't have a really large estate, you may need to do this planning in 2021, because if you're giving a $2 million property in 2022, you might have a tax bill, right? So again, this is not current law. I want to stress, this is not current law. I am not a big fan of trying to predict what's going to happen in the future. I'm not clairvoyant, but I'm just, I'm a citizen paying attention to the news, and a professional. We think the taxes are going to go up. The bottom line is assemble your A team now. Get on it. It's May when we're recording this, May of 2021. If you wait till July or August or September, it's probably going to be too late. So you need to assemble your A team as soon as possible. That's your CPA, your lawyer, your insurance professional, your financial advisor, whatever it is, whoever that team is, you need to assemble those because people are already very busy in my industry, in the estate planning industry. So let's talk about Prop 13 taxes and how to save them for your loved ones. So your low Prop 13 tax base is worth protecting because when there is a change in ownership is defined under California law as a sale. That's kind of obvious, right? I sell my house to somebody else. That's a change in ownership, pretty obvious. Gift, I give my home to my son. Kind of obvious, right? That it's a change in ownership. But death, this is the one that sneaks up on people, and I don't think people pay enough attention to this. Death is a change in ownership. You can't take it with you. When you die, when you leave this earth, your stuff stays here. It doesn't go with you. Kind of obvious, but that does constitute a change in ownership. So if you had a parent who died, we get these calls a lot. They say, mom died 5 years ago, and my brother's the trustee, and I stopped talking to my brother 4 years ago and nothing's happened. Well, there was a change in ownership 5 years ago when mom died. Okay. Assuming mom owned the property. So, and when property changes hands, when there's a change in ownership, property is assessed at its fair market value. It is not assessed at the amount it was sold for. It's assessed at its fair market value. So there's no gaming the system. You can't sell your house for $1 to your kid and get around that. That just doesn't work. And many times the taxes go way, way up. So I pulled this. If you're watching this video and this is your house, I apologize. I pulled this off of a publicly available information as I was getting ready for this yesterday. So this is May 5th, Cinco de Mayo. And I pulled this up. This home in Santa Barbara is presently listed today for $1,150,000. Everyone knows where Santa Barbara is. Nice place to live. The property taxes on this property are $1,648 a year. How do I know that? Well, because it's publicly available information, and we'll take a look at that. But these taxes are $1,648 a year. How is this possible, right? Well, that's Prop 13, right? Whoever has this house probably had it for a long time. So if you buy a house a long time ago, as we know, your property taxes don't go up that much year over year. The next door neighbor might be paying $1,600 a month, but this person here is paying $1,600 a year. So again, property is assessed at 1% of its fair market value when there's a change in ownership. And when Prop 13 was passed in 1978, the average assessment was 2.67%. So Prop 13 did a couple of really important things. Number one, it capped the amount of increase. And as you can see here, I've highlighted that. Whatever your taxes are, they can only go up 2% a year maximum. But the other important thing is it actually cut the amount of tax that was paid. And this is, I don't think people pay enough attention to this. If you move to Texas, many times your property taxes are 3%, right? So you say, oh, well, I can get something cheaper in Texas. Well, that's true, but your property taxes are higher. Of course, you have an estate income tax. So these are all things that we look at when we counsel a client. A change in ownership, again, includes sale, gift, and death. That death is the sneaky one no one really pays enough attention to. And the property tax is increased by the California Consumer Price Index, capped at 2%. And there's a little makeup function in there. If it, the Consumer Price Index only goes up 1.2%, there's a makeup where they can increase your taxes later on. So the 2% annual cap on tax is the cap on the increase in the tax bill, basically, the assessment. But what's happened to real estate? Real estate's gone up in California on average over the last 40 years. It's actually 6.7%. I did the math. I went to the Federal Housing Authority's website and did some quick math. That's 6.7%. So over the last 40 years, property's gone up 6.7%. But for many people, their taxes have only gone up 2%. So that 4.7%, over time, over 40 years, 40 years, the longer you have it, the more you benefit. So the logic goes from Prop 13. But, even if you bought a house last year, even if you bought a house 2 or 3 years ago, you still benefit from Prop 13. And a lot of people don't think about this. They go, oh, Prop 13 is not for me. I didn't buy a house when Jimmy Carter was president. Okay. But no, Prop 13 protects you because it caps the tax at 1%. And so this is one benefit of living in California. You know, California has, a lot of people are criticizing California lately. I happen to be California native, probably a little biased. But there are a lot of good things about California. And one of the good things about California is our relatively, frankly, our low property taxes. So, but again, everyone's protected by Prop 13. So that's kind of the point of that. So again, I don't think people pay enough attention to their property tax bill. When is the last time you looked at your property tax bill, not the amount you had to pay, installment 1, installment 2, where you kind of take that apart at the bottom of the bill. But I'll tell you, I think not just normal people, but lawyers and CPAs, because we're not normal people, lawyers, right? I don't think people pay enough attention to their property tax bill. So here's the property tax bill of the property that I just put up in Santa Barbara. This is publicly available information, and you can see the name is omitted. Again, if this is your house, I apologize. Hopefully it's not, but it's very important to pay attention to a property tax bill. Again, so there's a lot of information on here. And what I'm going to do is I'm going to walk you through how to read a property tax bill. So if you're a lawyer or a CPA or a financial advisor, and you're watching this, this is really important going forward on counseling clients on the property tax consequences of transferring property, whether it's death, sale, or gift. Okay. So the property tax bill, the first thing I look at when I look at a client's property tax bill, and I'll explain why a little bit later, is the homeowner's exemption. Now in California, what is a homeowner's exemption? Well, that's the amount that is deducted. So when you see this gross total here of 105,828, what the state does is they say, you know, you can subtract $7,000 if this is your home, and your assessed value drops to $98,000. Now, if you happen to be a disabled veteran, which many of our clients are disabled veterans, your exemption is $147,000. So when you look at this total, it's more than 105. That's even better because you're probably not paying any tax, right? At least no ad valorem tax. And then if your income is under, if you're a low income disabled vet, you get even a better benefit. So I would say action item, if you're a disabled vet, and what I've seen is I believe it's 100% disability, typically 100% service-connected disability. So if you are a disabled vet and you're not taking the homeowner's exemption, again, you need to pay attention to your bill because you might be overpaying on your taxes, okay? And many times you can actually get a refund if you go back many years. So those are the homeowner's exemption. So it's either going to be a homeowner's exemption or a disabled veteran's exemption. That's going to be the line item that's on there. For our purposes, they're the same, okay? And that's important because not only does it drop your overall tax bill a little, like $70 a year, but it also has some other really tangible benefits that we're gonna go over. So here's how you read a tax bill. There are ad valorem taxes. These are your ad valorem. You can see where it says ad valorem in the red bar there. That's, you know, derived from the value. It's Latin, and it's 1% of the value. And you can see that 4 zeros, the 000 basic 1%. And then there's some extra sweeteners on there, right? Or bidders, whatever your viewpoint is. These are some extra taxes that have passed typically by 2/3 vote of the people. And you've got a Goleta Union bond and the Santa Barbara Unified High School bond. So those look like they were passed in 2000, 2010, and 2016. And then the Santa Barbara City College bond from 2008. So not a whole lot of money, okay? But on some of these property tax bills, you know, these can be significant. So Alameda County, Oakland often has a lot of extra taxes. We see them a lot in San Francisco, depending on where you are in the city or, you know, the county, city/county. We see them in Los Angeles. So the sort of the older cities oftentimes have additional significant taxes. Now we'll go to these parcel taxes. These are fixed taxes. Okay. So these are the flat amount that you pay. It's like, okay, it's $531 for the Goleta Sanitation District service charge. Vector control, mosquitoes. If your neighbor has a green pool, you call vector control and they, you know, shame on you, neighbor, you got to fix your pool. So these are the taxes that appear on your bill. Why am I even going through this? This is really important because when it comes to transferring property to your children, for example, and we'll use an example of transferring the property to the son, we really do need to pay attention to this because the question is, how much are the taxes going to go up? Okay. And we need to know that. So our total taxes here, very low, $1.15 million property, taxes are $1,648. I put this up here just to show you the Prop 13 tax caps on the annual property tax increase. So this is a historical, I pulled this again off publicly available information. And you can see there's the land plus the structure. And you can see as time goes by from 2014 at the bottom of the screen to 2020 at the top, you're seeing that it's going up about 2% a year. And so that's what happens in California. The property can double or triple in value, but your taxes are only going to go up 2% per year. So what happens when there's a change in ownership? The property's reassessed. So this house is listed for sale. Let's say somebody buys the house, okay? And it's not a kid. It's just a random person, okay? The taxes under Prop 13 were $1,648. The property will be reassessed. The taxes jump to $12,572. That, folks, is a really big jump. 8x, something like that. What ends up happening is your ad valorem taxes increase. The parcel taxes typically stay where they're at because those are based on the parcel. But the ad valorem, or derived from the value, and that's why it's important to read a property tax bill, because if you say, hey, I want my kids to move near us and we have this rental property and we want to transfer it to them, you're going to get reassessed unless Prop 19 is extended. So it's really important to pay attention to this. But what if a child is the transferee of the property? And that's a legal word, which means the child is now the new owner. The child is the transferee. Well, now Prop 19 brought out this new thing called the family home exemption. And this is really important to understand. And this is, I will say, in talking to lawyers, we're all kind of looking at ourselves, scratching our head, what's going on? In preparing for this, I went onto the Board of Equalization's website, and they have a lot of helpful information for lawyers or people who want to spend the time learning what all those legal concepts mean. But if you are a lawyer and practicing in this area, I really would encourage you to go to the primary source and check it out on the Board of Equalization's website. So let's say mom gives, what a nice mom. She gives her son a $1.15 million home. Thanks, Mom. What a grateful son. What a nice mom. Well, let's look at the property taxes. The property taxes actually don't jump from $1,600 to $12,000. They only go up to $2,100. Now, this isn't a guess, this $2,180. It's not a guess. What I did is I applied the new $1 million family home reassessment exclusion. So what ends up happening is under Prop 19, and this is if the deadline is not extended, okay? Even if it's not extended, when mom gives her home, remember, she's got the homeowners exemption. If you don't have the homeowners exemption on there, you might have a little bit of a problem. If it is in fact mom's home, many times you can just call the county and say, hey, mom's been living here for 20 years and for some reason she never claimed the homeowners exemption. Can we get that done? Many times they'll do that. Whether or not you get a refund is a different question, but it's very important to have the homeowner's exemption because that really is prima facie, that proves that the home is, that mom's home that she's living in is in fact her home, so that when mom transfers the family home to son, the son has an extra $1 million reassessment exclusion, meaning $1 million in value can be transferred and the taxes don't change. So what ends up happening here when we do the math, when mom transfers the home has an assessed value of $105,000. And when mom gives the family home to her son, we add $1 million to the $105,000. Well, that takes us to $105,828. Within 1 year, the son must claim the homeowner's exemption. So again, pay attention to your tax bill, folks, because he really doesn't want to pay another $10,000 in property tax, right? So you need to pay attention to this. And the difference between the $1,150,000 and $1,105,000, $44,000, is subject to reassessment. And that increases the taxes. That increases the ad valorem, or deriving from the value of the property, the percentage tax, that increases it by $532. So I think a lot of people kind of get freaked out when Prop 19 passed, but in this case, not that big of a deal, right? Now, if there's no mortgage on the house and there's $1 million Biden exemption, mom's going to have to pay, 45% tax on that $150,000. So that's why I was saying you need to pay attention to the Biden changes that are afoot. If you're making a gift of a $500,000 house, maybe you're not as concerned about it. If you're making a gift of a $2 million house, yeah, you really need to pay attention to the change, that what we anticipate being a change in the law. Now, something to note, the $1 million exemption beginning February 16 of 2023 and every year thereafter, that $1 million exemption is indexed to the FHA house price index for California. That is increased by an average of 6.7 a year, 6.7%. Some years it goes down, and some years it goes up. It can go up by 12%. It can go down by 3%. Okay, so this is a number that's going to change, but this is a one-time exemption. So what I mean by that is when the property changes hands, as I read the Board of Equalization's materials, and for lawyers and CPAs, this is really important, please pay attention. When a property changes hands in a given year, they apply the applicable reassessment exclusion. So if the property changes hands in 2025, maybe it'll be $1,100,000 that's excluded from reassessment. So we just don't know what that's going to be, because we don't know what the FHA housing index is going to be. So, kind of taking a little bit deeper dive here, the assessed value is 105,000, 44,000 is added to the 105. So it's not like $1 million it's not treated like a homeowner's exemption where you have another exemption, a line item exemption. What ends up happening, as I read, and this is very new, by the way, the Board of Equalization's materials, is as I read it, they take a snapshot. What was the date of the transaction? There's a reassessment exclusion of $1 million, but they're going to add 44,000 to the 105. Now that's a really big benefit, because combined, now your assessed value, actually the numbers happen to equal 150,000. I had to triple check it. That 150,000 is subject to a 2% annual increase. Okay, it's different than the having it reassessed and then subtracting $1 million, but having that reassessed value then increase by 2% a year if you're following this. So as I read these materials, this is very important. How you calculate the numbers has a very long-term impact. So stated another way, when that property changes hands, the assessor looks at the property and they say, okay, it's $1,150,000. We're going to effectively subtract $1 million from the fair market value. It's another way of, I'm calculating this as the Board of Equalization calculates it. I think there's a simpler way. It kind of reminds me of the Italian philosopher who said, I would have written a shorter letter, but I didn't have enough time. Another way of looking at it is you can take the market value of the property minus the $1 million assessment, and that's your new assessment. That it's 6 or 1/2 dozen. Okay. And then again, that $1 million exemption is tied to the FHA house price index for California. The new $150,000 this is a term, if you do look at the primary source materials on the Board of Equalization's website, factored base year value. Factored base year value is the assessed value that increases every 2% every year. Okay. And again, housing prices have increased to 6.22%. So again, the timing of the transfer will be relevant. So if you know that the FHA housing index is increasing and you're looking at a gift on December 30th, maybe we should make that gift on January 2nd. I don't know, right? Because you're going to have more of an exemption. So there's mindfulness that you need to have with this. And I will tell you folks, I did see the people who've reserved. We actually have former assessors on the webinar here today. This is an area that requires a lot more thought and frankly, a lot more planning, because these have very long-term benefits that, you might not think, oh, if I pay another $5,000 a year, it's not that big of a deal. But over time, right? Over time, it's a big deal. So in our case here, with the Prop 19 family home exemption, the taxes over a 20-year period. So this is when mom gives the property to the son. The sum of the taxes, we know it's quantifiable because they can only go up 2% a year, right? $50,294. Without Prop 19 family home exemption, $302,000. That is a $250,000 difference. Now, I want you to think of how much you have to have invested to give you $250,000 over a 20-year period. It's a lot of money because we're in a very low interest rate environment. Now, this must be a family home. And as I read the rules, if this ever stops being the family home, taxes go up. Okay. Property's reassessed. Okay. It's very kind of unclear on what happens if it stops being the family home. This is very important to understand. This is family home. So, pre-Prop 19, mom could give her home to the son and the son could turn around and rent it out. and it's not going to get reassessed. But under the new rules, it has to stay the family home. You have to keep the homeowner's exemption. Can you lie? Can you keep your homeowner's exemption and rent it out? That is tax fraud. Okay. It's probably a crime. Yeah, it probably is a crime. Okay. So don't do it. You have to be truthful. The $1 million exemption seems to be applied at the data transfer only, and once applied does not increase. And so when I was going through this, and because I've been thinking about this a lot, I was like, well, it's that $1 million increase. Does that mean that, you know, your exemption increases every year? As I read the Board of Equalization's rules, it is a one-time reassessment exclusion, and then you end up with a new factored base year value, which is your Prop 13 tax rate. So transferring Prop 19, we have a whole other couple webinars on this. If you're here to say, okay, that's great, but I'm not giving my property to my kid, I'm selling it and I'm moving. Okay. Pay attention to this slide. If you're 55 and over, severely disabled, or a victim of a wildfire or natural disaster, you can sell your home. The home must be reassessed. So you can't give your home to your kid. Okay. And then take your Prop 13 tax base. Doesn't work that way. The property you're transferring, the property that you're leaving, has to be sold. Okay, you got to sell it, and it has to be your home. And so if you have a baked-in really big capital gain, that's another kind of tax planning puzzle we have to work out if you want to avoid paying capital gains tax. You can do it 3 times. And as I read the rules, if you've already done it under Prop 60 and Prop 90, if you've already done it once, you've got 3 more shots at it. If the property is of greater value, and this is really key because the Prop 60, Prop 90 exemptions, where you could move from one, you could move within the county or to one of 10 other counties in California. By moving within the county or moving to another county, you keep your low property tax base, but the property had to be of equal or lesser value. And if the property had a market value, even a real small increase, they give you a little bit of breathing room if a year or two has gone by, but let's say the property's 20% more, the full property is getting reassessed. So with Prop 19, it's only that extra 20% delta that gets reassessed. So this is a very powerful tool. Again, we have webinars on this. I would encourage you, if you're trying to figure this out, if you're trying to plan your retirement, if you're trying to plan a move, and you're trying to kind of quantify the numbers and run those, I would encourage you to look at our webinars. And, you know, once you understand the concept, I think the math is not particularly difficult if you can learn how to read your tax bill. But again, if you need help, that's something our firm, we're helping clients with that. If they're like, I just can't even deal with this, we certainly help them with that. If you're another professional, a CPA, financial advisor, another attorney, I really would encourage you to figure this stuff out, because it's a real value add for your client, because this is hard stuff to figure out. Okay, this is not easy stuff. So, and you go anywhere in California. So let's talk about the family farm. This is a weird one. Okay, I'll just say the family farm is kind of interesting. So a family farm is defined under the Government Code Section 51201 as any real property which is under cultivation or which is being used for pasture or grazing, or that is used to produce any agricultural commodity. Agricultural commodity is plant and animal products for commercial purposes, including biofuels, shockingly industrial hemp. Okay. We can make a lot of jokes about that, but let's look at we'll look at some examples. So the family farm of the transfer of the parent must become the family farm of at least one eligible transferee, which in our case is the children. There is a grandparent to grandchild exclusion, but both parents have to be dead. Okay, so you can't go from grandparents to grandchildren and use this exemption, whether it's a family home or the family farm, but both parents of the child have to be deceased. And we just don't see that often, quite frankly. So if the transfer is of a family farm, an eligible transferee does not have to file a claim for the homeowner's exemption or disabled veterans exemption. Okay, a family farm is not required to include a principal residence to qualify for this exclusion. And this is a real needle mover. So if you have ag properties, if you have ranch properties, this is a per parcel exemption. And you need to send a thank you note to the Farm Bureau, because they were the ones who really nudged the Board of Equalization to adopt a per parcel exemption. It's not just like one parcel per person. If you have 100 parcels, it's essentially a $100 million reassessment exclusion. It's $1 million per parcel exclusion. So if you're a farmer, this is a great idea. I think, the United States has had a cheap food policy for 100 years. The amount of money that we spend as Americans on food as a percentage of income, I think it's probably the lowest in the world. And there's a reason that we subsidize farming. It's because we need to feed people. Okay. And so this is a good thing. And California feeds the world. So it's good to keep the property taxes low and keep these farmers productive. Okay. So examples of a family farm include, I'm just going to go through some images here. And I'm going to pose a question. Okay. That's a family farm. We've got some hardworking people out there, row crops. Okay. That would be considered a family farm. It's owned by the family. Now, if you say, well, grandpa bought that parcel in a C corporation, we need to pay attention to that. Okay. Or dad, it's in an LLC. We need to pay attention to that. It's not in mom and dad's name. It's in some other structure. You need to pay attention to that because there's many times, especially with the legacy farming properties, those are held by different entities. And that's a whole next level of complexity. Okay. Here's another family farm. This is a Napa farm, right? So for those of you who like wine or love Napa, that's a beautiful vineyard in the fall, right? Near, looks like right after crush, because I don't see any fruit on there. And of course, almonds. If you're in the Central Valley, it's an almond. And if you're in the Sacramento Valley, it's an almond, like salmon. And then of course we have industrial hemp. I had to throw that in there because that's included in the family farm. But what about these family farms? Not those. I just like this cute picture of sheep. Is this a family farm? I see chickens, and eggs are a commodity. Okay. Is this a family farm? So if mom and dad own this and they're renting the house out and they carve out a rental agreement that says we're going to rent the backyard, we're going to keep the backyard, and we're going to grow eggs with these 3 chickens who will lay about what? I don't know, 12 eggs a week, a dozen a week. Does that count? I don't know. I don't know. It's gaming the system. What about this? You put your horse in your backyard. That's grazing. Okay. The horses eat grass. Is that pasture land? There's no parcel size. I've not seen any evidence of a parcel size, required parcel size. Or how about this? Oranges are a traded agricultural commodity. If you grow these and sell them, and this is a rental, this is where I'm going with this, because if it's a family home, we take the family home exemption. But if this is a rental, and again, if you're an assessor watching this, because we do get assessors on here, I don't envy your position. And this may seem a little comical and trite, but this is a real issue, right? Is this a family farm? I don't know. Okay. I don't know. But the definition is pasture or grazing, growing agricultural commodities. Eggs are commodities, oranges are commodities, and the horse grazing on grass is, and the industrial hemp. Go figure. I don't know. So what can you do going forward with properties that don't avoid reassessment as family homes and family farms? Now, what we're talking about is commercial, industrial, multifamily, single family rentals. I would say consider using a limited liability company going forward. And there's a really big reason to do this. There is something called original owner status. What is original owner status? Original owner status is defined as the person who acquires the property and it's reassessed. That is the classic definition of an original owner. If I buy a house from a third party and I am reassessed, I am the original owner. If I create an LLC and buy a multifamily home, the LLC is the original owner. And the rules with LLCs and entities and original owners is so long as no one gets more than 50% ownership, or control changes hands, the property might never be reassessed, okay? Ever, if you pay attention to it. So let's look at an example here. Andy creates Franklin LLC. This happens to be in Los Angeles on Franklin Avenue or Franklin Street, right? I believe it's West Hollywood. Buys a multifamily home in 1986 for $500,000 with the LLC. In 2021, the assessed value is $1 million, but the fair market value is $3 million. Now, remember, we went through that where your property taxes only go up 2%, but real estate goes up over 6% a year. That's how this ends up. In 2021, Andy gives half of his LLC shares to his kids, Betty and Charlie, so they each get 50%. There is no reassessment. If this property were in Andy's name as an individual, the property would be reassessed. So it's very important to understand original owner, LLC. Now, what if you already have a property? If you put that into an LLC and the property is reassessed, if you just suck it up and get it reassessed, you become the original owner. Okay, so there you can do that. So now let's take a spin on it. Andy creates Franklin LLC, same facts in 2021, $1 million fair market value, $1 million assessed value, fair market value of $3 million. And in 2021, Andy gives 51% to Betty and 49% to Charlie, full reassessment because Betty got 51%. Right, so you need to pay attention to this. And especially if you're a CPA or a lawyer or a financial advisor, be very careful the advice that you give to clients when it comes to real estate and entities. You really just need to be aware of this so you can say, you know, you either have competency in it or you don't, okay? But you need to be forthcoming with your client. And I think that is the best policy is like, oh, you know, I saw Jem on this webinar and you got an entity, an LLC and a piece of property. Before we start moving shares around, let's really take a close look at this. So when an LLC is not an original owner is where the property was not reassessed when the LLC acquired the property. And basically, if my wife and I acquire a property 20 years ago and we say, you know, we want an LLC because we're liability protection management, whatever reason we want. My wife and I, we put that property into an LLC. There's no reassessment, but that LLC is not the original owner. Okay. And so those rules simply just don't apply. So when you're not an original owner, Andy buys a multifamily in 1986. In 1990, Andy transfers the property, the multifamily home, to Franklin LLC. So 4 years later, the property is not reassessed. In 2021, the assessment's $1 million, fair market value is $3 million. Andy then gives half his shares to his daughter and half his shares to his son. Full reassessment. Full reassessment. Okay. What if Andy gives 50% of his LLC shares to Betty and keeps 50%? No reassessment. Kind of cool because not more than 50% is transferred, right? So if it's not the original owner, when more than 50% transfers, reassessment. If it's the original owner, as long as as long as one person doesn't get more than 50%, you're okay. So if you're not an original owner and you transfer more than 50% of the shares, reassessed. If you are an original owner, you can transfer all the shares as long as no one person gets more than 50%. Insider tip, consider acquiring a property that you intend to hold long-term in an LLC. So if you say, you know what, this is a legacy property, we're going to hold it a long time, really think about putting that in an LLC. A lot of people say, LLC, I don't want to pay the $800 minimum franchise tax. I can tell you for the CPAs here, it's a collective eye roll because if this is an income producing property, effectively that 800 is severely diminished, if not going away entirely. So go ahead and subscribe to our YouTube page. I'm going to open it up for questions here in a minute. If you want to set it, if you want to meet with us, if you want some help with your situation, you can go ahead and request an appointment. You go to cunninghamlegal.com and you can click the request an appointment. I would really encourage you to do this online, not call us. We are really busy like everyone else. And the best way to get a hold of us is going online. We still are under the COVID rules in our office, and we still have a lot of remote people. So it's best to go online. And also when you're completing the online request for an appointment, and I just saw a typo, for an appointment, just put in as Prop 19 or Prop 13 consult. And please mention that it's a Prop 19 consult. Then we know how to rank it. We're giving priority to Prop 19 consults, quite frankly, and sort of Biden planning with the Biden tax hike. I say that in a complete apolitical sense. I'm not taking sides either way. I'm just identifying it. So we also have a lot of other videos on the expiration of the Trump era tax breaks and the new Biden ones as well. So I'll open it up for questions. So we got, let's see, no audio. All right. So Carol says, what would the passage of ACA 9 do to Prop 19 situation? I don't know. I don't know what ACA 9 is, Carol. I'm sorry. Anonymous asks, who sets the fair market value, the assessor, or can I get it from Zillow? The word assessor means, valuation person. The assessor conducts an independent assessment of the property, and you can certainly provide information. You can certainly dispute assessed value, which is not uncommon because there are many ways to measure value. That is a whole legal practice. Okay. Is it cost of construction? Is it fair market value? Is it some capitalization rate? There are a lot of ways to value property. So anonymous, I would say, to answer your question specifically, who sets the fair market value? It's the assessor. So the assessor does that, but there is an appeals process. What can be done for a grandchild who wants to live in the house gifted to a parent? Well, the grandchild can live in the house. What you can't do, Roxanne, is there's something called the step transaction doctrine. So if you take the family home and it goes from the grandparents to the parent, and then the next day it goes from the parent to the grandkid, the assessor is going to go, come on, what are you doing? We're going to just mash those transactions up and we're going to reassess the property. But in our experience, if enough time has passed in between, and there are reasons other than evading taxes, sometimes we can effectuate, given enough time and given the right circumstances, sometimes we can effectuate a legitimate, lawful, non-step transaction that ultimately results in a grandparent to grandchild, but is heavily dependent on its facts, FACTS. Anonymous asks, property was an aunt's, and when she passed, it was placed in a family trust. The 1957 original value was $10,000. The property is now a rental, and Zillow has a value of $1.2 million. How does Prop 19 affect trusts? Anonymous, fantastic question. The assessor, and I probably should have mentioned this, the assessor looks through a trust and sees who the beneficiaries are. Those are deemed the owners. The assessor does not look through an entity like an LLC or a corporation or a partnership. So the assessor looks through and they look at who the beneficiary is. That's a person who gets, not necessarily the trustee, but the beneficiary. And so that's something we could certainly help you out with that. I don't have enough facts to tell you what would happen or not. Again, this is not legal advice. I'm just going through these and giving you my thoughts. So before Prop 19 took effect, I have done an irrevocable trust with a house gifted to my child, but now I have doubts that it was the right thing to do, and maybe I can do something about it to request an appointment. Especially as you just mentioned, the Prop 19 due date can be extended. The trust has a provision that I retain a limited power of appointment over the trust property. If I will file the gift tax for my house now to get a parent-child exclusion, can the value of the house still be included in my gross estate on my death to allow the step up in basis, or is this gift an incomplete transfer? And how should I not, and should I not file the gift tax now? Anonymous, you need to pay attention to this, because this did not happen in our office, because as we read Prop 19, if you grant a property and retain a limited power of appointment, when the limited power of appointment terminates, as I read the Board of Equalization's rules, that's when the change in ownership occurs. That is an incomplete, typically, and I'm not telling you what you, because I haven't seen it, but under law, when you make a gift of property and retain a limited power of appointment, that is known as an incomplete gift. So you don't file a gift tax return. It is included in your estate, typically. But I would pay attention to that. I know there were some lawyers, and I'm not going to throw shade on lawyers because this all happened very fast with Prop 19. There were some lawyers who were advocating retaining a limited power of appointment. My concern is that if you look at Revenue and Taxation Code section 63.1, there is a three-prong test that you have to pass in order to effectuate a change in ownership. And I'm afraid if you retain a limited power of appointment, you may not have effectuated a change in ownership, but I don't know if the county has said, oh yeah, the property's in the kid's name, parent to child reassessment exclusion applies. That's a tough one. I would recommend you make an appointment and we take a look at it, or just go back to the lawyer that, that drafted it What's my consultation fee? It depends on what we're doing. Prop 19 is going to be $1,000 for the consult. We end up putting about 3 hours into each matter for a 1 hour consult. So there's prep and there's the meeting and there's the follow-up. But at the end of the meeting, you know if you need to do something or not. Okay. Jean asks, hi, Jean, how you doing? Jean asks, what is the homeowner's age is 54, but will be 55 in a few months. Would he be eligible for the third time roll of his homeowner's exemption if he sells at age 54? You know, Jean, there are no answers. I really wish I could just say, yeah, I saw it on the Board of Equalization's website. As I read it, there is a time period by which you must claim your this 3-time transfer of your property tax base. You have to be 55 to claim it, as I read it. You know, so arguably you could sell it at 54, and Jean happens to be a lawyer. So, and I think you're older than 54, so it's not you, it's probably a client, but I think it probably would work. I don't know though. I mean, I would call the assessor. And the problem is I've had a lot of people reach out to us and they say, hey, Jim, I want to do this. What, you know, will this work? And this is where it's important to have a lawyer, because the lawyer knows exactly the question to ask the assessor in a way where you're actually going to get a response. Well, I did get a response from the assessor, and this happened to be the Sonoma County assessor. And they said, gee, we don't know. We're waiting for guidance from the Board of Equalization. So this is very frustrating for everyone. It's frustrating for the clients. It's frustrating for the lawyer, because we're just not getting answers. And hopefully Prop 19 will be extended, and then we can figure out all this stuff. And then we can write all the rule books so that we know, okay, in 2023, there's a new set of rules and we have clarity. But right now, we don't have clarity. Can you take both the homeowner's exemption and the family farm exemption? Again, the family farm exemption, there's not a family farm exemption that you file. So I would say you take your homeowner's exemption, but this family farm exemption is kind of a new thing. And there is not yet a family farm exemption. Now, there might be in the future, but as we saw in the slides, there's nothing now where you could even make that, because there's no ability to make it. How can an irrevocable trust protect against Prop 19 changes? Would it be an idea to combine that with a family LLC? How are rentals protected? Great question. I mean, you know, the reason we use the mechanism of an irrevocable trust and a lot of gifting was the parents wanted to gift the property to the children, but there's a real downside in gifting the property to the children. Number one, you lose control. That child can get a divorce. That child can die. That child can get sued. And then if you want income back from the property, how are you going to do that? Well, an irrevocable trust creates a mechanism that allows you to get some of the income back from the property in a way that doesn't mess with Prop 13. So yes, I would say you combine it with a trust in a family LLC. And by the way, with the Biden tax hikes, I will tell you guys something. There's really a trifecta going on in California right now. You've got, not only do you have the Biden tax hikes on the horizon, okay, but people have not been doing that type of planning. When I say people, I say lawyers really haven't been doing as much of that planning in the last 10 years as they did in the 10 years prior to that, or the 10 years prior to that, or the 10 years prior to that. So the last 10 years, when with our expanded exemptions, you know, we got an expanded death tax exemption under Obama. We got a sweetener and enhancer under the Trump tax. And again, I'm saying this apolitically. I'm just identifying it as when it happened. So the Trump tax law, which is the current one, gives you an $11.7 million gift and death tax exemption. That's huge, folks. That's $23.4 million for a married couple. I mean, who has that kind of money? A lot of people do, but a lot more people don't. Well, now that's going to get dropped to $3.5 million, maybe $7 million for a couple. And there's a lot of people who have, you know, $3.5 or $7 million or more. There are a lot of people out there in that position. You know, if you have a house and a retirement account in coastal California, you're probably there. So, so Michael says, hey, thanks for the great information. If Senate Bill 668 passes, would it be possible to protect a property from the effect of Prop 19? We were unable to do this due to the short deadline with the original proposition. Michael, yes, that's absolutely what's going on. That is the idea. And just to get your head around this, if your plan is to give more than $1 million in property, if your plan is to give more than $1 million in property, think about doing it this year, because we may end up with a Biden $1 million gift tax exemption. It's going to be problematic. Why on earth, why on earth is anonymous? I love the brand. Why on earth do we as non-lawyers, estate planning citizens of California and the US allow laws to be changed that impact estate plans already set in place? It seems insane that all this planning can be done and then somehow new law passes it and makes it all irrelevant. Well, anonymous, not quite irrelevant. It's just delayed. It will be around the corner. 700,000 families were affected by passage of Prop 19 in a negative way. And as I said, there are only 1,000 certified specialists in estate planning. The numbers, the math doesn't work. Is there any value in transferring property from an inheritance directly into an LLC controlled by the beneficiary as the new original owner? Anonymous, yes, in the sense that, and I'm not suggesting that you do this without talking to you, but the benefit is is locking in essentially forever, and I'll put that in air quotes, locking in forever the 2% per year increase in property taxes. So it's really an economic analysis, and this is something we help clients with, is we look at, what are your taxes now? What would they be? How long does the family want to hold this property? What are the prospects for the property? What's going on? And that really, there is a legal counseling process that we go through, and then we quantify it, and then you can make an economic decision. Because, when it comes to Prop 13, Prop 19, these are economic decisions. It's how am I going to pay the least taxes possible and provide for my family? So that's something we can certainly help you out. Oh, ACA, Carol, thank you. ACA 9 was introduced Monday, ostensibly would reverse the new Prop 19 inheritance tax on property passed from parents to children, but I'm not sure how. It would be a constitutional amendment. I read about it on Howard Jarvis's taxpayer website. Carol, thank you for bringing that to my attention. I'm definitely going to check that out. Julie says quickly, is there a checklist of items needed for Prop 19 consultation? Yes, Julie. If you contact us for a consultation, we send you the items that we need. And here's what it includes: a completed questionnaire, which is where we get your your personal and financial information, your property tax bills, the real one, not the one downloaded off the internet, but the actual property tax bill, and then your current estate plan. And if you're doing it for somebody else, one of the more complicating factors is if you're doing this for a parent, maybe the dad died and mom's living, there may be some trust administration in there. And so this is not, I will tell you, when we helped out clients with these Prop 13 matters, Prop 19 matters, we did a lot of them. Every case was different. I mean, everyone was its own little story. Nina asks, can you please explain how SB 668 will apply if approved by the legislature? How will the loophole to 2023 work? If the primary home and other properties are transferred to the child under Senate Bill 668, will stepped-up basis be lost on those properties when transferred? The Biden tax plan will most likely terminate stepped-up basis for estate and capital gains taxes. So wouldn't it be best to utilize higher lifetime gift tax exemptions this year, transfer properties to the child under Prop 19, and exclude those properties from estate, thereby saving death and capital gains taxes later? Yeah, Nina, that's basically it. And so, if we were clairvoyant and we knew when a grantor or donor, the parent in this situation, was going to pass away, we knew what their assets were, we knew what the tax laws were going to be, we'd have a lot more data to make an informed decision. But what many people are doing, and I will tell you, one thing that I've noticed in over 25 years of practice, I think for many of us, we see homeless people, and it just kills me to see it and see people suffering. Those people are living meal to meal, hand to mouth. They're worried about where their next meal is coming from, where they're going to sleep that night. Some people live like that. Many people live paycheck to paycheck. I would say most of the people that I work with and I encounter are thinking, by and large, year by year. So they think in mentally, okay, what's going to happen this year? What's going to happen next year? What I've noticed with really wealthy people is they think in much longer time horizons. They're thinking 5 years, 10 years, 20 years. They're thinking about their children. They're thinking about their grandchildren. And that's really how you create intergenerational wealth. And I know there's been a lot of coverage in the last year about injustice in the world and disparities between people of different ethnicities and backgrounds. And I think it's something that really people are starting to think about a lot more, which is, how can I create an intergenerational wealth? How can my kids afford to live near me so I can see my grandkids, right? How are my kids going to afford a house in a place that I want to live? These are really hard questions. So again, thinking longer term And that was, Nina, your question is, and what the point I want to make is a lot of people get wrapped around their axle on capital gains taxes. They say, well, I don't want to make a gift to I don't want to make a gift to my kids because I'm not going to get an adjusted cost basis at death. So basically, when you die, all your assets are included in your gross estate, and the government waves a magic wand, and everything. If you bought something for $1 and it's worth $3, the kids can sell it for $3 and pay no capital gains tax. That's a really big deal. We've got a lot of content on that on our YouTube page. Biden's plan is to take that away or really throttle it back. But I will tell you, the people with multi-generational viewpoints care less about property tax. They care less about capital gains tax. The big one is death tax, because that capital gains tax and property taxes, capital gains tax you can control. Property taxes is death by 1,000 cuts. Death tax, death by 1 cut. 45% goes, 77% goes. The Sanders plan is proposing a top rate of 77% death tax rate. James asks, have you had casework where the family put appreciated property now into an LLC, then give 50% to child 1 and later add child 2 after some time giving child 2 50% and parents' ownership falls away? Referring to your example on your website. Yes, that, James, that can be done, but you have to take, first of all, it can't be done solely for tax reasons. And what I've seen people do in the past, and I'm not saying that this is a plan that will work in the future. What I've seen people do in the past is I've seen people take the property, they make the first transfer for 50%, and then some time goes by, and then for a reason other than taxes, they take the property out, put it into a new LLC, and then transfer the other 50%. And that's what we're talking about on our website. But again, it's not my purpose as a lawyer to tell you how to game the system and cheat the assessor's office. It's telling you what I've seen other people do, and those have to be done for reasons other than taxes, okay? So it can't be done solely to avoid tax. It won't work. Anonymous attendee asks, for the question about irrevocable trust with limited power of appointment, can I still file a gift tax now and also the house to be included in my gross estate? I don't know. Yeah, sure, you can file a gift tax return. I don't know. I would have to check that out with you. You may want to go back to the lawyer that did that and kind of ping them and say, hey, you know, I was reading or I heard or saw this webinar of this guy who said you can't, if you have a retained limited power of appointment, you're not filing a gift tax return. I'm just speaking generally, and I'm not telling you to do one thing or another. So gross estate. So Jean asked, great presentation, Jim. Thanks. All right, thanks. Anna, this is so valuable. Can we get a copy of the webinar? Anna, this will be on YouTube. So it'll be up there. Michael says, any chance or movement you know of to add a proposition which would rescind or change Prop 19 to preserve Prop 13 tax base? You know, yeah, here's what I'm afraid is going to happen. People are losing their mind over Prop 19. And then a proposition will be put on the ballot that brings back the parent to child reassessment exclusion for residential, but reassesses commercial and industrial property. That was Prop 15 that barely went down. I mean, it was like 49, got 49% of the vote. That would have reassessed at fair market value commercial and industrial property. Okay. Anonymous asks, heard that there's also legislation to retroactively include properties gifted prior to Prop 19, effective date of 2/16. Is that true? What about the Van Hollen proposal? I'm not sure of the Van Hollen. And I'm not sure the gifting you may, I'm not sure if you're talking, Anonymous, about gifting for federal gift tax purposes or property tax purposes. Kirsten asks, revocable trust, mom's house is in this trust and would go to my brother and I. Can she gift it to us now? Would that then step up so we could sell now without capital gains tax? No, the basis carries over to the donee, Kirsten. And then James asks, have you had a case with putting a property in L? Okay, answered that. Campbell writes, family vacation property purchased in 1993 for $250, now worth $2 million. Father's the original owner in his trust. Could he transfer to an LLC with son getting 50%, and upon father's death, the other 50% goes to 5 grandchildren at 10% each? Would this arrangement trigger a reassessment? If dad puts a vacation property into an LLC, and again, this is not legal advice, this is just my thoughts on this, and transfers 50% to the son, that is not a change in ownership. But when the father dies and the other 50% transfers, it is a change in ownership and it does get reassessed. So you also have basis issues on there. Again, take this with a big grain of salt. This is just information to get you thinking about it. James says, thank you. Are you guys the right people for us to work with to figure out whether it should make sense to put our homes in an LLC now, or should be a financial advisor or accountant? That's a lawyer's job. And we do have financial advisors and accountants we can recommend, but whether a property goes into an LLC or not typically is done in conjunction with the lawyer, typically as a laboring or, and the CPA is there to make sure that the taxes are correctly reported. I would say typically you don't put a home in an LLC, although Gavin Newsom, if you're watching, you're living in a place that's owned by an LLC. So I don't know if it's good enough for the governor, but typically we don't put homes in an LLC. LLCs are businesses. You don't put a personal asset in an LLC. Then you get into issues of rent and all that. So it's been an hour. It's been great. And please subscribe to our YouTube page, and I'll see you maybe next week. Have a great day.